At least one place that we're sure we'll see a token drop is LayerZero. They announced they will be launching a token in 2024, so that's something to keep an eye out on, how you can get involved to be eligible for a potential airdrop. Welcome to Crypto with Cami, where I go over all the most interesting news in crypto and DeFi in the past week. In this episode, we'll review the major developments on the week of December 4th. To start off with, markets. That's the main thing that people in crypto and outside of crypto will be focusing on this week. It does feel like we're back in the full swing of the bull market. ETH and Bitcoin broke through their highest levels of the year at the start of the week, with ETH trading above 2,250 and Bitcoin exceeding 41,500 for the first time in 19 months. The largest two cryptos have since rallied further, with ETH at over 2,300 and Bitcoin at over 44,000. DeFi is also back, with loan volumes climbing to the highest since August 2022. So loans issued out of DeFi lending protocols climbed to 6 billion. That's the highest this year, the highest since August 2022, as DGens are back in the mood to gamble, or should I say trade. And with rising prices come, of course, airdrops. This week, we saw a good share of token fever with the Jito Airdrop. Jito is a liquid staking platform built on Solana. Think of it as the Lido of Solana. It's also the second largest protocol on Solana by TVL. And on Thursday, they airdropped 160 million of JTO tokens. It's a governance token meant for holders to participate in Jito governance. Jito will airdrop 10% of the total supply of the token, which will be 1 billion. Recipients got a windfall of tokens worth at least $10,000. And Jito's fully diluted valuation surpassed that of Lido at launch, with FDV at over 2 billion. But at the time of recording, it had since corrected or retracted back to below Lido's at 1.8 billion. In any case, huge numbers for Jito. Now, with the snapshot taken on November 25th, this is the kind of thing that starts getting that FOMO in. It starts to get people wondering when the next airdrop is going to be and how to get in on it. Well, at least one place that we're sure we'll see a token drop is LayerZero. They announced they will be launching a token in 2024. They tweeted this out on Thursday. Reminder that LayerZero is a cross-chain messaging protocol. It underpins the Stargate bridge, which is the third most used bridge. So that's something to keep an eye out on. If you see any utility to LayerZero, it might be worth seeing how you can get involved to be eligible for a potential airdrop. Now, staying on the rallying token theme, Helium token, HNT, was on a huge tear this week. It rallied 80% after Helium Network started offering its unlimited phone plan across the US together with T-Mobile. Now, what's interesting here is that users of the plan can earn crypto if they provide coverage for the Helium network by maintaining a hotspot. So the idea is that the tokens that they get in exchange for maintaining this hotspot, they can use in exchange to pay off their mobile bills and hopefully, make a bit of profit from that. Helium is also built on Solana, which continues to feed into this bullish narrative we've seen in the past month or so around Sol. Now, another bullish narrative is around ordinals. And this week we saw ORDI, ORDI, was the first token issued on ordinals to cross the 1 billion market cap milestone. So ORDI is now the largest BRC20 token. It had a near 1,000% increase in market cap in the past month. And background on Bitcoin ordinals, they're similar to Ethereum NFTs. They allow for arbitrary data to be inscribed on the lowest denomination of a Bitcoin, also known as a Satoshi. And this has led to a flurry of images and text to be inscribed on Bitcoin. They've become so popular that they've been driving up Bitcoin fees. But, most people, or most reasonable people, are thrilled about this because it means that Bitcoin gets more use case, more activity, other than just being a digital gold or bedrock, like some like to quip. But not everyone loves this development. Longtime Bitcoin Core maintainer Luke Dash Jr. said inscriptions are exploiting a vulnerability in Bitcoin Core, and they are equivalent to spam on the blockchain. So he said that his company, Ocean, which mines Bitcoin blocks, will be censoring or will be pushing a fix so that ordinals won't be, so that these inscriptions rather won't be allowed in the Bitcoin blocks that his company mines. Which, by the way, it's a very small fraction of Bitcoin blocks, so no users will be actually affected by this. Only Luke's company will be affected. Nick Carter said, I don't think I've ever seen a business launch in a competitive space that explicitly aims to earn less revenue than its peers. Good luck? ? So that's what's going on with inscriptions and ordinals. Separately, other than Bitcoin, inscriptions are really taking off across many different blockchains. We are seeing them take off on everything from Avalanche to Tron. I think Tron actually had an outage because of the popularity that inscriptions are gaining. So definitely a hot trend right now in the layer 1 space. These inscriptions, which again allow for NFTs, fungible tokens, and other things to be issued. We have some news from South America. So in Brazil, super interesting. We have this news article: Brazil's crypto rails get a boost from Itaú and Nubank. So two of Brazil's largest banks have announced efforts for their 195 million combined users to gain easier access to crypto. This is super interesting. So Brazil's largest bank by assets, Itaú Unibanco, on Monday launched a crypto trading platform. One day later, Nubank, one of the largest neobanks and South America's, Brazil's fourth largest bank by users, started offering USDC access. Sticking to South America news, Bukele, of course, El Salvador's famous Bitcoin president, was very happy to prove naysayers wrong and say that El Salvador's Bitcoin investment is now profitable. Now, to end, to finish off this episode, I have my hot take of the week. I'll try to make this a recurring theme, but this. My thoughts this week is on this, very long time debate in crypto, which is code is law. And this is, it's relevant because this week a French court cleared all charges against exploiters of the Platypus Finance automated market maker. The court argued that the hackers were not guilty of receiving stolen goods because they interacted with openly available smart contracts according to how the code was written. Code is law is a concept that exists previous to crypto, but has been adopted because it's very pertinent for blockchains, which are meant to be immutable, and what's written in code is meant to stay there forever and to be executed autonomously, and to not be censored. So it is very relevant. It's a core tenet and very core to the ethos of crypto and blockchain. But there's always been this debate of what if code that's written on chain is exploited and is used in a way that ends up being harmful for users, or ends up being used in a way that wasn't intended to be used. I think probably the most relevant debate around code is law happened, or I guess the highest profile debate around code is law happened at the time of the Ethereum DAO hack, when, as you all know, at the time Ethereum was just starting out as a layer 1 chain. There was this big project called the DAO, which was able to fundraise what at the time was around I think 15% of the ETH, of the total ETH in circulation. The contract holding this ETH was hacked, and the hacker was able to drain the contract. And so there was this debate on whether to fork Ethereum to censor effectively this hacker, return the funds to the contract, because it was a security vulnerability to have the hacker control a chunk of the network. And so, of course, the Ethereum community had this off-chain consensus, which ended up saying that code is not law, and that even if the contract was written in such a way that allowed for this exploit, in the end, there was an attacker who stole funds, and so those funds should be given back to their rightful owners. And so the Ethereum community decided to fork the Ethereum chain. This was the most high-profile debate. But this week, this issue was again raised in a French court, which was trying Platypus Finance and its attacker. And the court actually said code is law. So there was a code that was exploited in this automated market maker. The attacker was able to secure funds, drain smart contracts by using the platform in the way that it was set up, and so they didn't do anything wrong, and they were absolved of all charges. So this is super interesting, and I think, as you know, being someone in crypto, fully believing in this ethos of uncensorable systems, I still believe that there's more nuance to this. I don't think it's as simple as saying what's written in code should be upheld no matter what. I think that intent matters of both the developer of the code and the user of the code. I think the purpose of the protocol or dApp and the intention of the user of that dApp should be taken into account. If a user of a protocol is achieving a certain outcome by interacting with the code in a way that the developers did not intend, then that should weigh into whether that outcome that they achieved should be changed or reverted, especially if other users are hurt. So a simplified way of seeing this is a physical lock's intended purpose is to prevent access to, say, a safe. Someone, though, might know how to pick that lock and access funds inside the safe. So they found a vulnerability in that lock, but they're not using the lock in the way that was intended. The lock was made to secure a safe, and there are funds that don't belong to the lock picker inside the safe. So they've exploited a vulnerability, and they've produced an outcome that was not the desired outcome by the manufacturer of the lock or those keeping money in the safe. So this case is very straightforward. If that happened in, mostly anywhere, the lock picker would be found guilty of stealing the funds in the safe. So I don't know why it should be much different for smart contracts. So I'm not saying that blockchain should be rolled back and transactions should be censored. But like I said, I think there's a bit more nuance here to just saying code is law. I think if the code was exploited to make a protocol do something that it wasn't intended to do while harming users, then at least that should be considered. It should set a precedent for off-chain consensus, for DAO governance, for legal court systems to consider whether measures should be taken for the attacker to return the funds or for the victims to be compensated in some way. So yeah, let me know what you think in the comments. Like I said, I'm all for censorship resistance, but I do think that in the cases where users are hurt, when code is exploited in ways that the developer didn't intend for the code to be used, where there is malicious intent in the user of the code to steal funds, then all of those things should weigh in on, like I said, governance, whether it's on-chain governance or off-chain court system. All of that should weigh into how each situation is treated. So yeah, would love to know your thoughts on my hot take, and hopefully this rundown of headlines was useful to you. So that's all for this week. And yeah, click like and subscribe, and see you all next week.